Welcome back. Futures indicating a mixed opening this morning after a busy week of retail earnings, among other market movers. Take a look. Dow Industrial's up 94. The NASDAQ is lower by half a point. Lowe's, Best Buy, Dollar Tree, Costco, Kohl's, all set to report next week. But almost the most important issue that investors are watching are these debt ceiling negotiations. That also happening, extending into next week. Let's talk about it. Joining me right now is the Guidestone Capital Management's president and chief investment officer, David Spika. David, great to see you. Thanks very much for being here this morning.
Hi, Maria. How are you?
Let's talk about fundamentals. How would you assess the earnings that we saw this week? And what about your expectations for next week on retail?
Yeah, I think earnings have come in above expectations, but recognize the bar has been very low. In fact, the growth in earnings has been driven by just a couple of sectors, consumer discretionary among them. And that's the thing that gives us some pause, because consumers continue to spend very aggressively. They have jobs. They have money. They keep spending. That's going to keep inflation elevated. And that's a problem for the Fed. So, yeah, next week's retail earnings are going to be something we're going to have to keep an eye on. I would expect them to be fairly robust because consumers continue to spend. And that's a problem for the Fed. That's why we believe the Fed has to keep rates higher for longer than normal in order to quash inflation.
Yeah, I mean, we have seen demand destruction as a result of these 10 straight rate hikes, certainly in some areas like housing and the interest rate sensitive groups. But employment is still strong. We've got a tight labor market. And so until we actually see cracks in the employment story, we probably won't see that follow on to the consumer spending part of the story. What are your expectations for the next Fed meeting? Chairman Jay Powell is going to speak later this morning about monetary policy. We'll certainly be focused on that. But the Fed has been sending mixed messages about a potential pause in June. You've got the president of the Dallas Fed, Logan, saying that current data does not justify pausing the rate hikes yet. The Fed Governor Philip Jefferson says inflation is too high, but the impact of the rates have not been felt fully. And then you've got the St. Louis Federal Reserve President James Bullard suggesting higher rates as, quote, insurance against inflation, David. So right now, the futures market pricing in a 40% chance that the Fed raises rates in June. Where are you on that?
Well, Chairman Powell's been pretty clear that he's looking to pause if the data will support that. So I think between now and June, we're going to have some data come in and evaluate that and determine whether or not that's appropriate for a pause. The bottom line, though, Maria, is I don't think it matters. The Fed has raised interest rates by a full 5% in a little over a year, and it takes time for those rate hikes to work through the economy. So whether or not the Fed raises another quarter point, whether or not they pause, it really doesn't matter. We're at a point today where monetary policy is extremely restrictive. We've seen the largest decline in the money supply we've ever seen in history. That is going to have a negative impact on the economy. So I think this back and forth on is the Fed going to pause? Are they going to raise again? The real key is how long does the Fed funds rate stay at the current level, and how long does it take for liquidity to drain out of the system to the point where we can see inflation come down to a reasonable, sustainable level?
I'm with John Lonski this morning. Jump in, John.
You know, David is absolutely right. And I think the only way we are going to get inflation down towards that 2% target is via a very substantial, drastic reduction in consumer spending, at least the rate of growth of consumer spending. And that's going to require a loss of jobs and a higher unemployment rate. And all of this spells recession. There is going to be no taming of inflation without a recession. That recession strikes later this year, early next year, and may stick around long enough to affect the 2024 elections.
Yeah, David, you agree with that?
Oh, absolutely. There is no question in my mind that a recession is on the horizon. We cannot get the inflation rate anywhere near 2% without a recession. We've got to raise the unemployment rate probably by as much as 2% to curb consumer spending, to get inflation down. And the only way you get there is through a recession. And quite honestly, a recession would be healthy at this point. We've got massive excesses in the economy today. We haven't had a real recession since 2008. And we need a recession to reduce the excesses in the economy today. We can prune the excesses, just like you do the shrubs in your front yard, get the economy back in a healthy point, and then we can have sustainable growth going forward.
Real quick, David, do the debt ceiling negotiations play into your thinking at all?
They do not. I think it's a lot of political saber rattling.
Okay.
We're going to get an agreement. Neither party wants to own a default, and we're going to get an agreement, and it does not play in. It is something that on a short-term basis has caused a little bit of volatility, but no, we're not worried about it.
All right, David, thanks very much. Good to see you this morning. David Spika joining us in New York. Thank you, sir.